All right, folks, so here we go again, part two. So don't forget, got to know these names. Here you go. Chapter 2, question 2. A chart of account is, okay? Look at the answers here. Make sure you write it down because you're going to go ahead and take this and you're going to wind up using it on that quiz, okay? Okie doke, let's go on. So here's some transactions, okay? So look, so this one says Jordan incorporates Noodle Cake Studios on August 1st of the current year. Company issues stock to Jordan and Ty as evidence of their contribution of $10,000 cash, which is deposited in the bank account. So what you got to do is you got to think, okay, what happened here? Well, Jordan and Ty gave $10,000 in cash, right? And Noodle Cake give up the common stock. So take a look at what happens here, okay? So their assets, this is from Noodle Cake's point of view, okay? This is from Noodle Cake's point of view. Their assets increased by $10,000 in their common stock, so they sold stock. So what happened was the cash is increasing, right? And the common stock is increasing because these two, Jordan and Ty, invested, okay? All right, question 3. What is the accounting equation? Just for review, folks, one of these guys is the accounting equation, or perhaps none of the above. Make sure you write your answer down because you're going to have to put it on Canvas, okay? All right, next one. Noodle Cake pays $300 cash to create the company's logo, all right? So what happens here? Noodle Cake takes $300 that they have and they pay somebody to create a logo or a trademark, okay? So notice, these are both assets. So in this case, remember they said that there's always two impacts? Now, most of the time, they're on both sides here, but in this case, we gave up one asset, cash. We gave up one asset, cash, to get another asset, the logo or trademark, okay? So this was just an exchange of assets, okay? Same thing if you had cash and you bought a computer for $2,000. Yes, your cash would go down $2,000, but your asset computer would go up $2,000, so your assets would stay the same. They would only change what they consisted of, okay? Next one here, they're going to get a loan from the bank. So Noodle Cake borrows $20,000 from a bank, okay? $20,000 a bank. They deposit the funds in its bank and sign a formal agreement. So by the way, when it says formal agreement, usually that's a note payable. Okay, note, because it's formal. Somebody wrote something. And they're going to pay it back in 2 years. So notice what happens. Their cash goes up by $20,000. Why? Because they borrowed it from the bank. But now they owe $20,000 more in liabilities. And that's going to, right? So what happened was $20,000 in cash, but now we owe $20,000. See how it stays in balance? Okay. Next one. Now we're going to invest in some equipment. So Noodle Cake purchases and receives $9,600 in computers, printers, and desks in exchange for a promise to pay at the end of the month. Now notice here they're only borrowing the money for a short period of time. Okay? And they didn't mention anything about a document. Okay? So when that happens, it's a short period of time, they don't mention document, that's called an account payable. It's another type of liability. Okay? It's a liability, they owe it, but there's no formal note. So notice their assets increase by $9,600 and their accounts payable, their liabilities increase. So again, notice everything stays in balance, okay? That's one of the things you need to know. When you're doing journal entries, the numbers always have to balance. If they don't, something is wrong. And again, they're investing in equipment, and equipments are assets. And again, if you watch that debit and credit video, you'll know how important that is. Okay, and we're going to talk about that in this video in just a little bit. But if you watch that one, you'll already know what's going on. Okay? Now, it says here they're going to pay the supplier. So notice, Noodle Cake pays $5,000 to the equipment supplier. Okay? So what happens is their cash goes down by $5,000. Why? Because they paid their supplier, but also that liability goes down. Right? So remember, they owed them $9,600, and so far they've given them $5,000. So their liabilities are going to go down because they paid off 5,000 of it, but their cash is going to go down because they had to use the cash to do that. All right. Now it says Noodle Cake signs a contract with a programmer for a program code for the Enchanted World game app for $9,000. Now they haven't received the code yet. Okay. So here it says here they sign a contract, and it says here program code. No code has been received yet. Okay. So what it says, they sign a contract, so they didn't pay yet. Okay. So they didn't pay it. They only signed a contract. So that this is not a transaction. Okay? Not a transaction. Why is it not a transaction? Because they didn't pay anything yet. They're just telling you that they signed a contract. They're not saying they paid anything, and they haven't received the code. Okay? So no change, no change, no change. Why? Because it wasn't really a transaction. Okay, now they're going to receive that software. It says Noodle Cake receives the software for $9,000. Noodle Cake gives cash of $4,000 and a promise to pay $5,000 on account. So what they did, take a look. They got their software, so that increases their assets. Okay, they paid $4,000 in cash. That decreases their assets. And then their accounts payable, they're going to their liabilities went up because they're going to pay them that $5,000 later. That's going up. So if you notice, when you net these two together, you see how it equals 5,000 here? And over here, you see this 5,000? So you see, sometimes you have more than one item, right? But at the end, those things have to balance. It could be 2 or 3 over here and 1 over here or whatever. So the number of items on each side doesn't have to match, but the numbers have to match. Okay, like in this case, we have 2 on the asset side and only 1 on the liability side, but the net matches up. Okay. All right, next one here, it says they receive supplies on account. Notice here, Noodle Cake receives supplies costing $6,000 on account. When they say on account, that means they're going to pay later. So this means pay later. Okay. So in other words, they basically got them on credit. So notice their supplies go up, right? Now just imagine we got the supplies, but we're not paying for them now. We're going to pay later. So our liabilities, our account payable is going to increase. We're going to owe them the money later. Okay. So you see, analyzing transactions not super hard to do. Just got to think it through. Just takes a second. Okay. All right. Next thing you do is you summarize all these, right? And they're showing you here. They're looking at it on a spreadsheet. Let's see if they got a bigger spreadsheet. Oh, well, no, they're going to show you on this one. But if you look here, here's all the assets, right? And here's all the liabilities. And here's the stockholders' equity. So what they're showing you, here's the first one. Remember, we got $10,000 in cash, and then there's the $10,000 in common stock, right? Then the next thing, we paid $300. We got a logo made for $300. So our logo, this asset went up, this asset went down, so it stayed even. Next, we borrowed $20,000 from the bank. See it here? Our cash goes up $20,000. Now we have a note payable of $20,000. All right. Now we got equipment for $9,600, and accounts payable, we're going to pay them later, $9,600. Here we paid $5,000 of that. So notice our account payable are going to go down by $5,000. And by the way, when you add all of these numbers up here, and you add all of these numbers up here, this is $40,200, and this comes out to be $40,200. And that's why, because they balance. They always have to equal. Okay? They always have to equal. So remember, this is what we're talking about. We analyze, then we record, then we summarize in these T accounts, then we prepare trial balance, and then we do the financial statements once we make sure everything. This is called the accounting cycle. Now, like it says here, most of the time it's computerized. Now, when you're learning, you're not going to learn on a computer. You're going to learn how this happens, because the problem is if you go straight to the computer, like a lot of people that get QuickBooks, but they don't understand what they're doing, they just make a mess of it because they don't really understand fundamentally what's going on beneath it. It's like somebody gives you great food to make a delicious dinner, but you don't know how to cook. Just because they gave you all the right ingredients doesn't mean you're going to come up with a great meal. All right, folks, that's part 2 from chapter 2. We'll be back with part 3 in just a minute.